I've been thinking a lot about just the cost of money in over the last couple of days. And so I went and started digging into some data points. And I was looking at like starting out with like our US debt versus GDP. And in 2000, it was 58%. Our US debt was 58%. Today, it's 122% and growing. And I got to thinking about I took the other side. Why is debt bad? Why isn't debt good? And how can you utilize debt to be on a good side of things? When is the right time to have debt versus not to have debt? And I came to this conclusion. I'm sort of writing off the idea that the 34 trillion plus that we have in debt as the United States, that's just a foregone. That's that ship has sailed. We're going to have that. The biggest problem we're going to have, unless it's addressed, is the service cost of that debt.
Yeah,
And
we're at $1 trillion a year now.
yeah, and the problem is the cost to service it. Now, to get anybody attracted to our debt right now is you got to have a higher payout, interest, a yield. And so it puts us in this really bad place. And then I started looking at it and I'm like, okay, so if we have 34 trillion in debt, I went off the US debt clock, and
Right.
we had US revenue of 4.2 trillion, and we have a interest debt service of 4.5 trillion. So we're just in the hole. So, and then you take that to the individual household, and the individual income is $39,500. In 2000, it was $31,788.
Yep.
And here's the crazy thing. I didn't realize how the difference between 2000 and 2024, the average household has gone from 163,000 to 114,000. And now you're financing that at a 7+% interest rate. Well, of course, that's going to kill the housing market.
Mm-hmm.
That's inevitable. That cost to do that. And then, of course, a car in 2000 was 22,000. Today it's 51,000. Enormous growth. But I got to thinking, like, what would cause what when will the Fed lower rates? Like, when will he be pushed so much that he has to lower rates? And I think we're getting there. The average household right now is spending 10% of their income on non-mortgage debt. So if your average household, let's assume two people work, that's 80K roughly, just under 80,000 household income, minus your taxes, this, that, and the other, and you're spending 10% on credit card debt or non-mortgage debt, you're spending close to $8,000 just on that alone at an average rate of 28% right now. And I'm like thinking to myself, number one, if you keep Fed funds rates where they are today, there is no way you're getting out of debt. There's just no way. Unless you inherit an enormous amount, you can pay it off. The Fed in my opinion, is going to be forced to drop rates by 100 basis points in the next 12 months. They're going to be forced to do it because
Which will cause higher inflation.
it it potentially, yes, but at some point that debt burden, not just on a federal level but on a household level, is going to get so great that if they don't do something, it'll crater households like in a big way.
When I think it's going to break, when unemployment finally starts getting up to the point where it it it, it causes the consumer who's supposedly resilient to stop spending because they've already maxed out their credit cards. They've eliminated their savings and now they've lost their job.
Yeah,
Okay. And so that I think will be the tipping point. It's the third tipping point to stagflation. Okay. And that's the last leg to go. And you already saw that unemployment rate, according to the official government figures, if you believe that, okay, uh, went to 3.9% off of 3.8%. And that's with increasing number of jobs.
Yeah. That, but everybody's getting a third, second, and third job. That's the problem.
Absolutely. And
It's
those all
not
count
people
as a
working.
job, whether
Right.
it's full time or part time.
Right. I was talking to Kerry last night about what will be the sign that stocks will come down further. And I pointed out to him, I said, when you start to see contribution rates to retirement plans starting to be decreased, you will start to see stocks fall because 401k contributions or qualified plan contributions is one of the biggest contributors on a monthly basis on the 1st and the 15th of each month. And that money goes into mutual funds. Well, if the mutual fund receives $1 billion, they have to go out and
Spend
deploy that money in those stocks. And that's why
at whatever the cost is.
at
Yeah, like
whatever,
like they're at an S&P ETF, they got to go buy whatever the percent of Apple is and Microsoft and all that at current cost.
right. And so when you start to see employees walk in to the HR department and say, "Hey, I need to reduce my contribution from 6%, so I can, to 4% or 3% or to zero," and having managed 401k plans in the past, in my past life, when you came into a recessionary environment like the great financial crisis, the first thing that went was the 401k contribution.
And in addition to that, not only do they reduce or eliminate putting that money in, they start taking it out in advance because they need to live. So they start
Yeah.
taking money out, paying the taxes if they have to, because
Yeah.
they need to live.
Yeah. And the discussion Kerry and I were having about this was that it isn't that I think NVIDIA is not going to sell more GPUs. It's the fact that the contributor to the retirement plan is going to start reducing the amount they're contributing. So that money that typically goes into that fund and then goes and buys proportionally the individual stocks within the fund is going to start to decline. And as you just pointed out, great example is that when now they can't make their bills. And so now they're going to start pulling money from their 401ks, which means you're
Oh,
selling those
and
funds.
thinking on that line of thought. So if I'm pulling money out, whether it's my 401k or I have an investment account with an S&P 500 ETF, and I need the money, so I'm starting to sell that. And not only am I selling it, you're selling it, everybody, a percentage of people to live on. Then all of a sudden, these funds have to sell at any price,
Right.
which the way that these ETFs are and how they're spread throughout so many, and you've got the same stocks, Microsoft, the Mag 7 plus, the Fortune, the Dow 30. These start to get sold in mass, and then it turns into a contagion, and that's when it just starts rolling off the edge. Because then you've got the logarithms going, okay, we just went past our number, and we're going to sell, and then you can't stop it.
Right. And then it just starts
How close?
snowballing.
How close do you think? How close do you think we are to that?
Um, I think they'll be forced to lower rates within the next 12 months by 100 basis points. So, but what would I don't think we're near the point of that triggering. And here's why I say that. I'm going to use the Airbnb entrepreneur example. I live in a high vacation spot in Florida. And I am now just hearing about spring break wasn't as good as it has been in the past. Like it wasn't, if there's 12 weeks of spring break, it's not half of, it wasn't down 25%. It was down like, you know, 2 of the 12 weeks was actually occupied. That's a major drop. And it could be really in particular to my area, but we get most of the Southeast comes to our area. So Atlanta, Georgia, Tennessee, Texas, that whole spectrum. Um, I think summer vacations were booked out a year in advance. So a lot of bookings are not showing that like spring break was. But I think it starts showing up in fourth quarter. And it starts to, we start to see the stagflation signs in third quarter earnings and third quarter, um, you know, debt service, third quarter, those kind of things. And it those numbers will come out in the first to fourth quarter, and I think that'll be a big rate of change between second quarter and third quarter. But once we get into the first year and we know who our fearless leader will be, um, then I think you get in to the first quarter of 2025, and that's when things really start to melt down, and it will happen quick, in my opinion.
It's interesting. We could talk a little bit about stagflation because all the big names and are poo-pooing that. Okay, well, we haven't had it since the 70s and 80s, and I was alive back then, so I remember it. Didn't quite understand it back then, but you know, Fed Powell came out and I see no signs of stagflation, and everyone thought he's this cute little old man, and everyone laughed at things. So, looking at stagflation, what is it? It's a term, and I have an economics degree, so I get to use it today. So it's a term used in economics to describe a period of slow economic growth and high inflation coupled with high unemployment. Okay, so those are the three elements: slow economic growth, high inflation, high unemployment. And so let's just take a look at, where are we today? Okay, because
Yeah.
I'm hearing, we see no signs of stagflation. Okay, so I'm looking at the world from two regular guys, how we look at the world. Okay, so in slow economic growth, the economy stalls or grows very slowly with little to no increase in production of goods and services, and that can lead to higher unemployment and business closures. Okay, we're already seeing business closures, and we're seeing bankruptcies rise in this country. So, where are we today? So let's just look. The U.S. economy, we're going to go to the GDP that just came out last week. U.S. economy expanded, annualized 1.6%, okay, in Q4 compared to 3.4% in the previous quarter and below the forecast of 2.5%. It marked a slowdown for the second consecutive quarter and the lowest growth since the contraction in the first half of 2022. And the slowdown was seen for consumer spending went down, mainly due to a fall in goods consumption. So the consumer isn't resilient, okay? They're not spending as much. But what they are doing because of inflation, that little bit that they are spending on costs more. So we see in the retail sales, hey, the retail sales went up. Well, it's not by the number of goods. We all know that, being two regular guys who have two regular wives who go to the store and say, this sack of groceries used to be, $25. Now it's $125 or 100, whatever it is.
Right.
So, when looking further in the GDP, government spent a lot less. And so that's what's been keeping our GDP up is government spending. Okay. And then we had exports that slowed. So are we really talking about growth? Let's look at construction spending. Construction spending fell by 0.2% from the previous month, following a revised flat reading in February and missing the forecast of a 0.3% rise. Construction spending's down. Okay, is that growth? No. Let's go to manufacturing. Last week, the ISM manufacturing PMI came out, fell to 49.2 in April from 50.3 the earlier month, firmly below the market expectations. The data pointed to a contraction in the U.S. manufacturing sector, failing to maintain earlier traction as the prior month pointed to the first expansion in 16 months. So we had 1 month that it went a little bit above 50, and that's gone. So are we seeing anything in growth in manufacturing? No. Okay, these are just a few things I see. All right, so let me move on a little bit. Higher inflation. Okay, and again, we have no stag, we have no inflation. Okay, so in higher inflations, we have prices of goods and services are rising, which eats away at our purchasing power and reduces consumer spending. Okay, so where are we today? So the U.S. PCE, the core price index for personal consumption, expenditures in the United States, which excludes food and energy, because no one needs food, no one needs energy, rose by an annualized 3.7% in the first quarter of this year, accelerating from a 2% increase in the previous 3-month period and above the estimate of 3.4%. Also, the headline index rose by an annualized 3.4%, accelerating from a 1.8% increase in the previous 3-month period. Okay, does that sound like inflation's coming down? Doesn't sound like it to me. These are government reports. Okay, I'm not making this up. Let's talk about labor costs. Human labor costs in U.S. non-farm business sector increased an annualized 4.7% in the first quarter after being unchanged in the previous period and above market forecast of 3.3%. Our labor costs are going up. Does this sound like inflation is going down? Absolutely not. Okay, let's go to higher unemployment. We hear that unemployment is, steady and sound. And you and I have talked about this before. We talked about how they manipulate the data. You have 3 jobs, that's 3 full-time jobs. You count it as 3 people, everything's fine. You look at the number of increases in jobs, they're part-time, they're not full-time. So the unemployment came out last week. So the unemployment rate in the United States went up to 3.9% from 3.8% in the previous month. And it surprised markets. Okay, it was surprising. Okay, they forecast it would be unchanged. So the number of unemployed individuals increased by 63,000 to 6.492 million, while employment levels went up by 25,000. Okay, and their labor participation rate was unchanged at 62.7%. Okay, so does that sound like we're going in the right direction on unemployment? No, we're not. In fact, the Fed even said we need to get unemployment higher, okay, to solve this inflation problem. There's our catch-22. Let's talk about job growth, okay? The U.S. economy added 175,000 jobs in April, a deceleration compared to the upward revised 315,000 jobs in March, okay? So they're revising this all over. So we're almost a half of where we were before, okay, in job growth. The latest data underscores a significant slowdown from the brisk pace observed in the first quarter and trails behind the average monthly gain of 242,000 jobs over the preceding 12 months. Okay, so again, here we are. The 3 categories are, to me, look like stagflation is coming, okay? And I don't care how much you want to laugh at me, just a regular guy. But when they tell me it's not there and you can go look these things up, tell me where I'm wrong. Tell me where I'm wrong.
Yeah, I think the worst thing he could do, the Fed could do, is be honest, because that will light markets up. It will burn down everything, and it will be a cliff dive. So he can't say the truth. He can hint at it. He can sort of beat around the bush. But right now, I feel like he's just sort of trying to negotiate a balsa wood bridge over the Grand Canyon. And just one more ounce of negativity or weight on it, it's just going to collapse. And I think that's where they're just in. Plus, it's a presidential election year. So he's playing both sides of that. He don't want to be seen as he's in favor of one or the other by inaction. So he's just basically, nobody move. Let's just get past November.
It's weird to me because, the Federal Reserve has a dual mandate, keep unemployment steady or low, okay, and keep inflation intact. Okay, that's their dual mandate. I didn't know they added a third one, that they had to keep the stock market inflated beyond it. And so now it's not the job of the Federal Reserve to worry about the stock market, but that seems to be exactly what they worry about the whole time.
Yeah. Well, and I think, it's sort of semi-understandable why he would be, because the majority of American household wealth is in the stock market. It is in their 401ks. It is in their non-qualified accounts. They inherit it. That's how it's mostly passed. And so it's sort of, if he tanks the market by 50%, you look at the majority of the people who are retiring or coming into retirement or in retirement, that's a big population, and all of a sudden you crush them. And now you're dealt with another issue. So there's really no good way other than, in my opinion, is to lower rates and just kick the can down the block, not around the corner. Just halfway down the block, and hope that people take advantage of it to get out of debt. But we don't do that. That isn't how we're designed as consumers. We're encouraged to take debt on. We're encouraged to buy new stuff. That's how our economy works. And so it's really
Well, we're a
like
debt-based society. Our economy is based on debt.
yeah.
That's where money comes from. Money comes from debt.
So taking the side of debt's okay, how do you I mean, that's where we're at. Every household is littered with 7,000 on average debt in credit cards or outside mortgage loans. How do you take the point of, well, this is what we got. How do we make it work? You know?
I think that a lot of people have just thrown up their hands and said, well, I might as well spend it, because I'm not going to be able to fix it. And you saw a little bit of that. I forgot what they called it. There was a term for that, right after, people couldn't pay their debt off. I might as well just go and, max them out, and who cares? Because maybe the government will come and reduce, forgive my student loan. Maybe they'll forgive my credit card debt now too,
Yeah. I
you
mean,
know?
honestly, when I was doing the research on the average credit card debt or a percentage, APR percentage at 28%, some are as high as 33. To me, that's a loan shark. That's illegal.
Oh, yeah. Yeah.
And we endorse that. I mean, our
Well,
country endorses that.
well, we
So
have we have lobbying groups that get into our senators and congressmen, and
yeah,
and that's where it's at. And it's a way to take people's money away from them and to take their wealth away from them.
yeah. And so it's just, change your phone number, I guess,
And in defense, people have the free choice.
They
People
do.
have the ability to say when they have a credit card, can I afford this? Okay. And they also have the ability to say, can I pay this off at the end of every month and be disciplined enough to do it? I pay mine off, almost every week. I'll just, whatever's on there, I just pay it off.
Yeah.
Okay. So, I realize I'm fortunate enough to be able to do that. But, there is some individual responsibility too, that when you take out a credit card or you take out a student loan and you put your name on there, that you will pay it back and you understand what you're actually getting into at what rate.
Yeah. Well, and I agree with that. The problem I think a lot of people are experiencing is Ginger and I have this conversation every so often that not everybody is a creative entrepreneur. There are people who are limited to a certain path in life. If it's because of what they were exposed to, because of their personal will and desire. And I think the majority of Americans are in that path of this is what I was educated and designed to do, and it has a limitation. And I think you and I have spoken about in the past about people are now paying their groceries on their credit cards, or they're taking payday loan, the pay as you go type of loans.
Right.
Um, that's a I have to feed my family element. That's not a I need a new Gucci purse or new pair of Nike tennis shoes. It's more of I need to stay physically and mentally alive. And so
Well,
now they're limited. So I think that's where I look at, if the government's going to come in and do anything on a credit card relief element, they need to cap how much interest can be charged, but they've never done that. But they're getting
I think
paid real well by them, so why would they?
we have a drift or a rift between the people we watch on financial channels who make a lot of money and they don't live in the economy that most people live in.
Right.
Okay, so they don't see, our government officials ride around in cars and they get free lunches and they jet around on government jets. They don't have to spend the things like you and I do. We've got people in the financial channels, and Kerry talks about, Kramer makes 5 million plus whatever he makes on the side. And all these guys make millions of dollars, and they don't have to worry about food and costs and all that. I mean, they make enough money. And then there's people, the rest of the country, where 65% of the people live paycheck to paycheck in this country.
Yeah.
Okay, those are the people that are being hit by it, but they don't. Those government numbers don't show them. Okay, they just show the top line, and they don't take it down. They just they just make it to this is the average. We
Right.
were talking about 401ks. Okay, and one thing we have to realize is that half the country doesn't have an IRA or a 401k. So that's 150 million, 160, 70 million people do not have it. Okay. So they
Right.
don't have that retirement. So, when they're not being included in the wealth factor of the markets.
Yeah.
So they could care less what the market does.
It's you went to the Berkshire event this
I did.
past weekend, and I saw Warren Buffett. He made the comment that I guess Berkshire paid 1 point or 5.8 billion in taxes or something
I
like
don't know.
that.
Yeah, I don't know exactly. They pay a lot of taxes.
It was is over 5 billion. And he said if 800 companies would pay that, you would not have to have federal income tax. And at one point in our history as a country, we didn't have that. So if you
No, it was not part of our country.
yeah, you think about if there was a restructuring of that. I mean, if Amazon's going to make billions of dollars each year, why not have them pay that out, not loop it through a bunch of loopholes and stuff, and have them pay that out? And you take all the, like, take Warren's idea, take 800 companies that pay in X number of billions of dollars, and then all of a sudden you're freeing up the average American household roughly 25%
Well,
in
I
income
could,
tax.
I could
Now you can
call
make
that.
money.
I could call that an inadvertent tax on the consumer because if I'm a company and I
Right.
have to pay more in taxes, you're going to pay it, not me. I'm going to add it into the cost of my product.
True. But
That's
it's
exactly what's going to happen.
but the product is a choice.
Well, not when it comes to food or transportation
True.
or heat or air conditioning or housing.
Do they charge taxes on food in Nebraska?
They're trying to pass a law to do that. They don't on certain products right now,
They don't. Okay. They
but
do
it's
enforce.
in the legislature now to try to do that.
Okay. I guess
I mean,
so.
and our property taxes are the third highest in the country.
Yeah.
And
Yeah.
they're like, oh, that's because we've got this land and we've got to service 1.4 million people, and it takes. I'm like, well, it shouldn't cost that much to service 1.4 million people.
Right.
If you choose to live in the sandhills in the middle of nowhere, we don't need a 2-lane highway to go to your house. So the mailman can get there.
Right.
But that's what their thoughts are.
It's a predicament, a very big predicament our country is in right now. And I think it's one of these that has festered for the last 30 years and is growing and growing. And now we're approaching a tipping point where something has to change. If it's the US defaults on its debt, or if it's the consumer defaults on his debt, or there's some sort of reduction in spending. I mean, Janet Yellen is on a spending spree, you
Well,
know,
that's
constantly
the
borrowing
that's
money.
well, yeah. What did they say? $2 million a minute is what they came
God,
down with. Yeah, and so I mean,
that's
it's good
insane.
for us. It's good for the people, I know in the Platinum Channel, a lot of us, we we put our money into the short term Treasury bills, and we're getting
Yeah,
5.4%, annualized, and that's better than sitting in your bank account, if you're not trading or setting it off to the side, and we teach that over in Platinum, and just one of our good guys, our one of our best guys over there, and subscriber. He's like, yeah. He says, he's pretty much. I turned into you, Mark. He said, I got 80% of my money in treasuries right now, just waiting to see what happens. And
I mean, you
we
can't.
don't give advice, but we give people opportunities to understand other areas where they can put cash or make their money work.
Yeah, and you think about going along with my thesis of the Fed will drop Fed funds rates by 100 basis points in the next 12 months. Why not? Why sidestep the risk of a potential market drop because he will lower rates because the market crumbles? You sit in treasuries and you pick up, what a 1 month is 5.5.5% or something like
Yeah,
that
a
right
little
now.
under, yeah,
Yeah.
yeah,
I mean,
annualized, yeah.
Yeah, that's great money. You just roll that every 30 days until you get that opportunity where stocks drop and they react with, okay, we're going to cut rates. And all of a sudden that money flows back in. You buy on the, on the dip, on the big dip, and you make wealth instead of just riding up and down and complaining about your grocery bill.
You can look at charts though, and it's the history of rate increases and decreases, and you know you see eventually, right out of the gate when they drop rates, the market will go up, but then shortly after it dumps. Yeah,
yeah,
in just about each and every case of a Fed, and you can see the plateau. They all plateau and they hold them, and then they start reducing rates, and they usually start reducing rates because something went wrong.
right.
Okay, and you
They're
and I've
always
talked
late.
about it. We're at a normalized, historically long average of this is normalized rates where we are right now.
Yeah,
You know,
yeah.
5 to 5.25%.
Well,
So
here's what's interesting. I pulled up the 1 month average on the US Treasury bill today is 5.51%. The long-term average of that is 1.45%. That's 3.8 times what the long-term average is.
mhm.
So if you haven't been a part of the whole um, opportunity in bonds going back, what, 30, 40 years, your opportunity is starting to show up a bit where you could buy bonds 1 month or 10 year. I think the 10-year average is 12 months ago, it was 3.52 compared to its 4.47%. There's an opportunity in bonds because once bonds price or yields start to come down, the values go up.
Right.
But right now you can pick it up and just sit on it and make great money on that money. It's boring, but it's
But yeah, I mean, that's another thing, that the yield curve has been inverted for as long as it's ever been inverted. And
yeah,
and again, history shows that when it reinverts itself, we go into a recession.
yeah,
Okay. Now that's not me saying that. That's just looking at history,
right,
and not saying that that's going to happen. It could be different this time, but it never has been in the past.
right.
So,
But
you
it
know,
and those are the kind of things that you look for when you really want to take advantage of an opportunity. And I think that's, like you said, they lower rates, you get a bump high, and then you get a dump, and that's when you start to shop. And I think
well,
that creates wealth.
well, watch what the big guys do. Look what
Yeah.
they're doing now. Look at the guys who sold stock: Jamie Dimon,
Mm-hmm.
Elon Musk, Bezos. Why
Yeah.
they don't sell at the bottom? They never do, and those
No.
guys just sold again. Okay.
Yeah. Yeah. And you look at what Buffett trimmed his Apple position by
Oh yeah.
13%.
Yep.
Stan Druckenmiller came out on
Well,
CNBC the other day and said he bought Nvidia at roughly $113 and he started trimming it back and cutting his position out over 900. I mean,
well,
that's risk management, folks.
yeah.
Take the profits, pay the taxes.
Berkshire has $180 billion in cash, and he anticipates by the end of the next quarter he'll have over 200 billion in cash. Can't find a place to put it, he says. I cannot find a deal at this point. The market's overvalued for it. Okay, he is waiting.
Yeah.
Okay, and he's patient.
Yeah.
And what's he do? Puts them in treasuries at 5.5% right now.
Yeah.
That's
Jeez.
what he's doing.
That's a ton of
Think of
money.
what, well, and then you think about, he's got Coke and he's got Amex, and just the Coca-Cola dividend alone is more than most companies make, in a
Yeah.
year, majority of the
It
companies in this country.
and it's not that complex. You just when everything goes through the roof and it's high on it's like my house. I should have sold my house in uh in the beginning of 2023. I would have walked away with 200,000 more than if I sold it today.
Right.
Yeah.
Well, and it's probably not getting any better now, is
Oh no, it's going down. Yeah. And I think I figure another 150, 200,000 off where it is right now will be the bottom. But if I had sold it, and I think that's just a lesson in risk management is it isn't that you
Well,
don't. you'd poo-poo the stock because you're selling it. You're just taking advantage of the opportunity of creating personal wealth.
Well,
You know?
again, don't beat yourself up too much about selling your house because you would have
Yeah.
to go buy another one, or you can't unless
I'd
you
have
lived in
to
a
rent.
tent,
Right.
unless you got a van and live down by the river.
No, don't have one of those. They're
Oh,
too
well,
expensive too.
yeah,
But I mean, I think it's just when you look at your positions and you've made an enormous amount of money, it's okay to take a little off the table. Pay the taxes if it's a non-qualified. If it's a in a qualified account, you don't have to pay the taxes. You get another opportunity to buy it at a cheaper price. So, but yeah, I don't know. It's this. I've been thinking a lot about the whole debt thing recently, and the biggest problem with debt is the service cost. And right now, service cost is through the roof,
yeah,
and that's
yeah.
what
And
kills.
that's unsustainable. It really
Yeah,
is for the country. And we can just go back in history and see what happened to the Romans and Carthaginians and the Spanish, and the British. Same things happen. We don't learn from history. We
yeah,
read history, we forget history. We don't learn from it. And we have this modern monetary theory or whatever that people on some parts believe in, that you can just keep printing forever. And I think they found out, in Germany, you can't do that either, because that didn't work out very well for them,
no,
after World War One. So, you know, understand history, understand that you, as regular people like us, have the ability to think. And now we have AI, and we have forums like this in the Platinum Channel, where we actually get people together from all over the country and the world to listen and tell us about what's going on. This is what's going on in Austria. This is what's going on in Florida and New Jersey. This is what we're seeing in Oklahoma. This is what I see in California. And it's fascinating. That we go through the reports, and it says, the government tells us everything's okay, and then you talk to us regular guys, in the Platinum Channel, or gals, we're like, that's not what I'm seeing.
yeah,
It's fascinating.
it is, but it's
So, I
also
mean,
the
we can
truth.
we can take back our own financial management by understanding what it is, and using the same tools and techniques that the people who are trying to take our money away do.
Yeah. So as a side note, I saw this video about why Jeff Bezos pays no income tax. Not I don't know for a fact he doesn't pay income tax, but they explained that his income comes from borrowed money that he securitizes with his Amazon or other investments.
Yeah, they
And
all do that.
that's how they all do it. And they
Yeah,
sidestep it. And I'm
yeah.
looking at that going, wow.
Then then
Great.
then
I'm
they
like,
get on TV. They get on TV and say, "Oh, everyone needs to pay their fair share."
yeah, right, right.
Yeah.
And I'm like, well, how do you do that on an individual level? Unfortunately, the problem is what that asset produces in revenue or income can pay the service of that debt. Whereas right now, as you an individual went out and did that, and say your average household income is 80,000, and you went to go get $80,000 worth of debt to pay yourself instead of taking that income, that asset that you're securitizing isn't producing the cost to service that debt.
Well,
And
let me give
that's
you
why
an
it doesn't work.
example. There is an example where it does work, and that was with MicroStrategy. Michael
Right,
Saylor bought all this Bitcoin, and then he went out and he did convertible debt at less than 1%.
right.
And he takes that money and says, "Okay, I'm going to go out and buy Bitcoin with this," and he does. And he gives you the option, at the end of your 6 or 5 years, he'll pay you your 0.6%, and he'll say you can either convert what you have back into MicroStrategy stock, or I'll pay you out, because his bet, and it's been proven, at least so far, that
Yeah,
his Bitcoin value is going to go up way higher than what he owes you, and he will just take some of that Bitcoin, pay you off, and do the same thing over and over again. So he's using leverage at a very low interest rate to go
yeah.
out and secure a very finite amount. There's only so much Bitcoin, with the bet that that's going to go up, and it has. It's been the best performing asset class since it's been uh, when
Inception.
it came around. Yeah, when it came around 15 years ago,
Yeah,
and so he's using that to leverage up and buy more. So he's becoming richer by using leverage, leveraging into an asset that is finite in the amount that you can have. It's a supply and demand. The demand is high, supply is low. price goes up, and that's what
Yeah,
he sees, and that's what he's doing successfully so far.
that's great. Yeah.
It
And
is. It is.
it's just digging into it and figuring out how it works. And these rich guys, that's how they do it. So, and that's what we hope to share with you all is different ways to think about this market. So
Well,
join the Platinum channel.
just as regular guys and regular
Right.
gals, you know, because
Exactly.
together we can work this out and give ourselves a fighting chance. You know,
Exactly. And I think, you're stronger in a group rather than as an individual. So, you know, all right, Mark. Well, I think any last words, anything else you want to hit on?
well, I mean, just be careful out there and remember it's your money. No one cares about your money more than you do. Okay. And you may have financial advisors, and they are really good financial advisors out there. And there are some that don't talk to you except for once a year, maybe. So, you
Yeah.
know, but take a little interest in what your finances are, and think about it and ask the right questions of your financial advisor and see if that meets with your expectations.
Yeah. It's your responsibility.
Absolutely. No one else cares if you have a good retirement or not, but you.
Yeah. That's it. All right. Well, thank you again for
Yeah.
y'all participating. And we'll see you next
If they
week.
have any comments, leave us some comments because we're
Yeah,
always trying to read
hit the
those. And
subscribe button.
yep,
Follow us on here on Best of US Investors,
hit the
and
like
come check
button.
us out at
Yeah.
bestofusinvestors.com and learn more about what we're doing and how we're helping people become better investors. All right. See you.